Hello, I'm John Crendler. Welcome to This Week in the Markets. To borrow the phrase from Charles Dickens, to the U.S. consumer, it's the best of times and the worst of times, depending on where you are in economic strata. For many lower middle class households, the percentage of their budget attributed to food has never been higher since 1994. It leaves very little after food, rent, mortgage, gasoline. For others, though, the discretionary spending has led to a boom in many parts of the economic cycle. This is evidenced through the conference calls and corporate earnings over the last few weeks. All this has to be synthesized by the Federal Reserve in their March 19th and 20th meeting. Will it be higher for longer? They'll be data dependent and really will make sure that inflation is not going to bump up and rise again and bring it down to their 2% inflation mandate? Or will they try and lessen load for many corporations and households and pivot in May and June and start lowering rates then? It all remains to be seen. In this part, the bond market is staying in the upper part of its range, 2-year 4.7% to 10-year 4.3%, an inversion, but a narrow one nonetheless. Stock market indexes stay within a couple of percentage points of all-time highs, again waiting on important data in March as well as the Federal Reserve meeting. One thing I'm looking at is the energy sector. U.S. domestic production for oil and gas has never been higher. A cogent public policy for exploration and distribution of oil and natural gas could be a boon for the U.S. economy, as well as helping out our global partners, considering all the disturbances geopolitically throughout the world. I'm John Kreitler. Thank you again for watching This Week in the Markets. Have a great week.